We have managed to buy the house 9 years in advance. We have also saved ourselves an interest of roughly $160,000. In this video, I'm going to talk through the secrets of what a mortgage or a house loan comprises. The money you pay in a month, and over the course of the life of the loan, how much money you end up paying at the end. The results will quite surprise you because most often when somebody buys a house, the first thing they look at is how much is it going to be monthly, and they don't look at how much is it for the long run and when can they finally call their house their own. So here in this video, I just want to walk you through a couple of scenarios using this exclusive spreadsheet that you will get at the end of this video. Using the spreadsheet, I'll show you how your amount of payment impacts how much you will end up paying over the long run and how much money you effectively lose to paying off the interest on a housing loan. Now for this explainer, I'll simply take, let's say, a house worth $300,000 charged at 7.5% per annum for 40 years. $300,000 will be paid off every month in small installments so that over the course of 40 years you are expected to have paid it off fully. And of course you will also be paying the interest on that $300,000, which is the 7.5%. This $300,000 house at a 7.5% per year interest rate over a course of 40-year period, I have done the math, and it comes up to roughly $1,970 that you would need to pay every month so that at the end of 40 years you would have cleared off the loan entirely and owned the house. So we're going to take a couple of examples where first we, let's say, don't pay anything at all and we keep the house for 40 years. How much interest are you going to owe? Of course, that would not come to pass because the lenders would want the money back and often repossess the house. In the second example, we'll see that you do pay something, but not even enough to cover the interest. The third scenario will be paying off just the interest amount. And again, we'll keep going back to the spreadsheet to show some quick math. In the fourth example, we'll be paying slightly more than the interest amount to try to knock off some of the loan that we have borrowed. Then next, we'll pay just the right amount so that at the end of the entire period, we'll have cleared off the entire loan. And then there are a few more examples talking about how going beyond that amount of payment makes how big of a difference. So let's take the first example. What will happen if you never pay? So you've got a $300,000 loan at 7.5% per year for 40 years. So as you can see in the calculation, every month the interest gets added to the total amount that you owe. And then that interest in the next month accrues its own interest, and then that whole new amount accrues its more interest, and then that whole amount also gets its own interest on it. So it is only an increasing pyramid, and it just keeps going on all the way to the end. So when you finally reach the end, the 40 years or 480 months, at the end of 480 months, you will end up owing $6 million. So now there'll only be two things that can happen. Either the house will get repossessed fairly quickly, or we'll end up repeating the 2008 financial crash all over again. Next example, which is a bit more practical, so I won't be showing any calculations. But you get the idea that if you pay down less than the interest amount, whatever little interest is remaining will continue to add on to the full amount and then gradually increase. You might come across posts that say something like, my wife and I have graduated roughly 30-40 years ago, and then every single month we've been paying off our student loans. It was only $30,000 at the beginning, but guess what? After paying for the past 30 years, it's now $50,000. So the college graduates after 30 years were shocked to see their amount increase, and they couldn't do such a simple math. So you need to be wary of paying less than the interest amount if you don't want that number to explode even to a bigger size. Now in the third example, something that we often see actually existing in the mortgage market out there is to pay off just the interest only. So in this example, again going back to the $300,000 for 7.5 years over 40 years, if we pay off just the interest, which comes up to $1,875, if we keep paying it off for 40 years, at the end of 40 years, we will have cleared off the interest, so that never got added on, but we still have the original amount remaining, that is the $300,000 of the house. But at the same time, the amount of money that you paid off to get rid of the interest over the course of the loan comes up to $900,000. So effectively, you would end up paying $1.2 million anyway if you wanted to buy the house at the very end. Of course, given that you've already paid off the $900,000 over the course of the lifetime of loan, the remaining $300,000 will not feel like $300,000 to you at that point because of inflation. So going by the trend of the past 40 years, that $300,000 will feel something like $92,000 in today's money, which is not too bad. So given our initial math, we came up with the number $1974. That's the amount required to completely pay off your $300,000 loan at 7.5% interest over 40 years. In the next example, let's say we choose to knock down the actual mortgage at least a small amount every month on top of the interest. Knowing that the interest that we would be getting is $1875, let's say we don't completely bother to pay off the loan, but instead focus on paying off just a little bit more. So let's say $25 more. So we pay $1,900 every month. We will be paying off the mortgage, although not as fast as the ideal way to completely pay it off in 40 years. Now, putting the number into our calculator, we find that at the end of 40 years, if you are only paying $25 more than the actual amount, then by the end of 40 years, you'll have paid $836,000 into the interest alone and still owe $224,000 on the house. So that's still a very big sum that you have left behind. So we now know that paying off just this small amount is not enough. So now let's come to the most obvious example, which is paying off just the exact amount. $300,000, 7.5%, 40 years. If you choose to pay just the exact amount as advertised by the lender, then we end up owning the house at the end of 40 years. Yay! But now, looking at how much interest I have paid over the life of this loan, I get this massive number of $647,000. But way better than paying off just $1,900, which would have resulted in me still owing $224,000 on the house. So we can imagine just increasing our monthly payment by $75 from the $1,900 to $1,974 point something dollars. We were able to completely own the house at the end of 40 years. Now I want to see how much more I can go beyond the 1974 so that I can clear the loan off even faster, and this is where the magic of mortgage comes in. So now let's go back to my calculator and decide that every month I'm going to pay off $100 more on top of the 1974. So I'm paying $2,074 a month. And so putting that number in, I find out that scrolling down, I find that I have completely paid off the loan by 377th month instead of the 480th month. Putting that back into the calculator gives me 31 years and 5 months. We get a saving of nearly 9 years. We have managed to buy the house 9 years in advance, simply by putting in $100 more than what the bank told us to put. And that's not just it. We've also saved on the interest. So coming back to the interest column, we find that we have paid roughly $480,000, which is very much better than the initial $647,000 that we were paying if we went by just the exact amount we needed to pay in 40 years to completely purchase the house. Not only have we bought the house 9 years early, we have also saved ourselves an interest of roughly $160,000. Now I'm interested. Let's push it even further. How about paying $250 extra a month on top of the amount we are required to pay? So quickly, we scroll down the table and we find that we've paid off the house in 298 months. Which, putting it back into the calculator, gives us 25 years, nearly halved. And all you had to do was increase the amount by $250 on top of the $1974. And on top of that, you are only paying $360,000 in interest, which is $286,000 less than what you would have paid if you only paid the exact amount needed to pay it off in 40 years. And even better, this is another $119,000 less than if you were putting in just $100 more than what was expected for you to pay. Now, another example. You might not always have $100, $250 lying around all the time. You can pay it irregularly as well. So coming back to the calculator, you can choose that in the third month you pay $100, in the fifth month you pay $250, seventh month you pay another $200. You can put that in easily and it'll calculate the rest for you. Now let's say you got a bonus at work of $5,000. And you decide that you, rather than just wasting it away in some random activity, you want to put it into the house. So in 1 month, let's say the 15th month, you decide to go all in and put the 5K in. The simple act of topping up your mortgage with a $5,000 lump sum payment in the 15th month in this case, coming back to the table, we see that we have paid off the house in 440 months, which is roughly 36 years and 8 months. We've still managed to save 3 years and 4 months with a one-off payment. And not just that, we've also saved ourselves $74,916 in future interest payments. Another quick example, let's say instead of the 15th month, we put it in the 3rd month. Again, just coming back to the calculator, plug the number in, and you find that you have saved yourself $80,000 and also bought your house in 36 years and 6 months. Now, of course, I will link the spreadsheet that I'm using to calculate all these numbers into the description of the video. Now, changing gears a bit and talking about one unknown benefit of paying off mortgage in excess. Let's say you stumble upon a hard time in the future and you cannot afford the amount for the mortgage. There are two options. Either you have like a mortgage insurance that covers some of your payments, or if not that, you can still fall back on the previous extra payments that you made to your lender and ask them to take out money from that extra payment and use it to pay off your current mortgage month. You can effectively avoid paying mortgage for a few months if you have been quite consistent in previously paying off your mortgage with a little bit more money than what was expected. So some lenders do allow you that option to fall back on that surplus that you have built up. And of course, if you never end up relying on that surplus will count towards you buying the house early. So now, a quick takeaway from all of this is that, oh my god, I'm paying hundreds of thousands of dollars in mortgage interest payments. And this is all just money disappearing down the drain. Not quite. Because if we are to follow the trend in the past 40 years about what's happening to house prices, we'll find out your $300,000 house today will be worth $900,000 at the end of 40 years. That is of course an average. So let's say if you live in an expensive area where big companies move in or something goes really well, then it might double or triple or quadruple in value. Only thing, you will need to continue living in that house to reap the benefit of that. And if you do ever choose to sell it, you know you can get pretty much all the money that you paid off in interest back into your account. As a final tip to somebody who's not interested in even buying a house, remember that student loan example at the beginning is similar to this. All you need to do is pay off more than what you need to clear off the student loan faster. Or even if not that, at least pay off the interest amount so that the number does not keep increasing.